Hello, my name is Nathan Musson and I am the Chief Economist here at Afriforesight. If you don't know us yet, Afriforesight is the largest mining sector research house in Africa. Primarily, we look at the outlooks for prices, profitability, and volumes for various commodity sectors, but we also assess the various input costs associated with developing or operating a mine, as well as maintain a database of existing and potential mining projects across sub-Saharan Africa, which we use as part of the basis for our comprehensive analyses of the resource sectors of African nations. If you would like more information on our work or how it can benefit your business, please contact Sebastian Naidu, our Business Development Executive. Today's discussion, though, is going to revolve around COVID in general, how it's impacting on the global economy, specifically how it's been affecting global stock markets, as well as general manufacturing activity. And then I'm going to dig down a little bit deeper into specific sectors which are resource heavy, showing you how the output and the cost of the various raw materials which factor into these industries have been affected through this year, and how those are affecting recent trends that we've seen for the recent years. And then I will tie up at the end with a brief discussion of our global growth outlook, looking at the short-term impact that we expect to play out to about the end of next year, but then also looking at more fundamental drivers which we think will drive growth trends for the next 5 to 6 years. But jumping straight into it, of course, we've all been well in the thick of this pandemic as it's been progressing around the world this year. And it started obviously with China very early this year and small parts of East Asia. But the real issue came apart when it spread out of that region and really took over in the northern hemisphere from about the end of the first quarter into the second quarter, specifically hitting the US and EU very hard, and many other developed nations in the northern hemisphere. And at the moment, we are now seeing a bit of a third wave come through, where lots of nations that were seemingly behind the curve or potentially maybe avoiding some of these issues are now really starting to see the infection take hold in their economies and force constraints to be put in place. And we're seeing lots of these volumes come through, obviously, in India and Brazil are very key markets at the moment, but many other places are highly impacted, like South Africa at the moment, who still has to maintain some form of constrictions to help prevent the spread of this virus. But despite the massive human toll that we all have to suffer through and the economic constraints that are holding back activity, global stock markets have been on a relatively positive trend for the past months. After at least there was an initial crash during March when the severity of this issue really hit home and concern about global growth was really undermined. But since April, we've been seeing quite a positive trend come through across global markets, driven mostly by the expectation of recovery of global economic activity as we extend through this crisis, but also supported by the various elements of government and central bank stimulus that we've been seeing come through in the last few months, pushing liquidity into markets and keeping interest rates very low, which for stock markets gives a relatively good environment and has been keeping them on a positive, albeit volatile trend for recent months. It's good to note here that these trends and these changes in trends were relatively synchronized across global markets, regardless of what was going on in specific areas. But if you look at the actual manufacturing outcomes, they are more nuanced and associated with the actual lockdowns and the timing of those as they came through in various economies. So it's very clear from this graph here that China was the first to see any sort of major lockdown. They were globally, and there was a very sharp contraction in February. But as they started to release their economy and ease constraints from March already, they've been in relatively slow but positive territory, growing there month by month as we went along. By comparison, you can see here that the EU and the US were impacted a bit later, only really having their worst contractions come through in April. And they also took quite a lot longer to start their recovery, needing about 3 to 4 months to show any sort of positive growth coming beyond this crisis. And Japan itself, and as this graph shows, is still lagging behind that general trend of recovery, and at the last reading was still contracting in July. But their last couple of outcomes do seem to be improved. But now, obviously, these constrictions were also heavily related around personal and business travel, and that impact can be very clearly seen in actual fuel demand on the ground. As an example, I'm showing the US market's fuel demand in this graph, and as they imposed their hard lockdown in late March, early April, there was a massive reduction in fuel demand that came through in that market. And since as they started to ease over the last few months, that demand has filtered back in. And despite the very big increase in resurgence in cases that we've seen come through in the US in recent weeks and months, the fact that they haven't moved back in and started to reimpose restrictions on activity and travel has left that demand relatively robust, and even still what could be considered pre-COVID levels at this point, despite that. But if they do bring back those restrictions, we should see another sharp pullback in fuel demand, but it should still be temporary as we ease those constraints as we go forward. Now, if you look at the alternate market of diesel in the US, given the fact that in the structure of the US, diesel is mostly used in industrial and freight applications rather than personal or business travel, the restrictions that came through in those markets didn't impact those activities of the economy so much, and that demand has stayed relatively robust throughout this period, despite all the issues that we're seeing in that economy. Another aspect of the energy sector which I'd like to touch on is obviously power demand, and with the constraints on business activity, we have seen quite a firm pullback across all markets since the beginning of this year. In many cases, this is exacerbating a seasonal trend as we came out of the Northern Hemisphere's winter. Generally, you'll see a decline in energy usage as a region comes out of winter. And the fact that demand has remained very low at this point has exacerbated that downwards trend. But in most cases, the overall level is not too significantly below where you might expect it to be. And China has even managed to maintain what seems like a positive growth trend throughout this crisis. But on the flip side there, you can see that India has definitely had its growth trend in power derailed in recent months, and it will take some time to come back into the fore as they recover from this crisis themselves. But this lack of demand and this very low demand that's pervading the markets has definitely put way down on prices for the various energy commodities. As you can see here, from the end of last year, we've had a very big pullback in most energy prices. But that has actually only extended an existing trend which has been coming through the markets in recent times, given the fact that we have fairly firm supply growth in all of these various aspects around the world, but a relatively slow demand growth, given the fact that a lot of economies are trying to shift away from these more environmentally risky hydrocarbon fuels towards more sustainable and environmentally friendly sources of power generation and fuel use. So that general trend has been weighing on markets throughout the last few years, but now with the massive shift down in demand, we've seen that those markets be quite depressed. And even though as we expect markets to improve and these prices to pick up through the rest of this year, they shouldn't reach the levels that you would have expected to see in early 2018, 2019, as that shift away from hydrocarbons is still happening slowly in the background, even if it's less on people's minds at this point in time. Looking at the global steel market at this point, first thing I'd like to draw your attention to is the general growth in supply that we've seen throughout most of the period that is shown here, with the time period from beginning of 2016 to about the middle of last year, showing a good 30% growth over those few years, which is very strong for any big industry like steel. But alongside that, the demand for steel was not as good across that period. So there was a general oversupply state in the market, which kept prices on a downwards trend in recent times. And that started to factor through last year with the issues in the market and the lower prices, pulling back on certain areas of growth and pushing down on supply as we went through the second half of last year. But now, as we entered into this year, despite the fact that we saw these restrictions come through early in China and then again in other steel-producing Northern Hemisphere's nations through the second quarter, this graph clearly shows that we had quite a pickup in steel output across the world, mainly driven by China, who was attempting to stimulate its economy, keep its growth outcomes relatively stable, and preserve employment. But now, obviously, as I've been mentioning, the demand side of this equation has been very weak of late, and especially here, as this graph shows, during February, in the height of China's restriction, when they were still pushing out volumes, their steel inventories rocketed up to record high levels. As they came out of the constrictions from March and into the second quarter, a lot of that steel was used as China started to really pick up its economic activity. But given the fact that it was coming from a very low base itself, and that the global economy was very weak throughout that period, we've been left with quite a high stock level for this time of year in any case. And now there's the bit of a risk that as we go through the second half of the year, China might pull back on its output a little bit in terms of new steel manufacturing and use some of these stockpiles that are lying around as we go through the year. So if we look at the raw materials side, there might be a bit of downwards pressure as we head through into the second half of this year. But to touch on prices for the last point in this section, I mentioned that that oversupply state in the general steel sector was pushing down on prices. It's very clear, as you can see here. In more recent times, what I was saying might have suggested that prices would fall quite sharply, given that we've got weak demand and relatively strong supply. But now, as you can see, that the prices only fell back quite moderately in the recent quarters, and that's due to the fact that there have been disruptions to the supply of the raw materials for steel production, mainly now iron ore and manganese. In terms of iron ore, it was because of issues coming through in the supply from Brazil, and for manganese, it was because of issues coming through in the supply from South Africa. Now, those constraints have kept the manufacturing cost of steel relatively high, despite the fact that the demand is quite low and people are trying to push down on prices. The fact that these raw material prices are high and on the rise has kept steel prices relatively stable despite the low demand and strong supply. Moving into the stainless steel sector, to again draw attention to the general trend in output over the last few years, this, like the crude steel sector, has shown quite a lot of firm growth in recent times, driven mostly by new projects popping up in Southeast Asia and primarily Indonesia, which has a lot of domestic nickel resources which it can use to integrate into its operations there and keep costs low. Now, this growth of low-cost production has kept markets very well supplied, even though there has been quite a lot of demand growth for stainless steel through the years. The fact that we've had this very strong pickup in supply from Southeast Asia has kept this market also with fundamental stainless steel prices on decline for recent years. And as we headed into this year, the slowdown in economic activity and the constraints on consumer spending really pushed through the markets, slowed down exports, and then forced a reduction in production. Even from China, who, as we saw on the crude steel side, was attempting to stimulate by keeping these industrial manufacturing activities supported or even expanding them if they can. In this particular instance, it didn't seem like there was the ability to do that, and this general malaise in the market is keeping demand and supply quite low, both at the same time. So now looking at the prices, as I mentioned, we had that general downwards trend given by the oversupply in recent years, but unlike in crude steel, the elevated issues or the elevated prices of raw materials is not so much a factor, or it's only impacting in certain areas at certain times. So as you can see here, nickel has not been evaluated as being at risk at this point, but chrome did have a bit of an upswing in the second quarter as volumes from South Africa became restricted due to our national lockdown, which pushed up on raw materials slightly. But given the extremely low demand in the market at the time, prices have fallen back quite firmly since the end of last year. The last section I'd like to touch on in terms of sector-specific analysis is now the auto sector, because it's worldwide, it's very ubiquitous, and it uses very many different sorts of commodities to manufacture the vehicles. But looking at general output here, the growth rate across global auto sales has been relatively slow across the years, basically just maintaining a general level as we've been progressing. But as we entered this year and the sharp lockdowns slowed down actual manufacturing of cars to sell, and then also the restrictions on travel, business and personal, reduced any desire to actually own or buy a new vehicle as we went through. So this market has been severely impacted by the COVID crisis early this year. But then we have seen quite a nice recovery come through in the first half of the year, the second quarter, going through into June and July, as those stimulus packages that I mentioned earlier helped to support some of the consumer spending and keep people as part of the active part of the economy. And they've started to return, as we see here, through June and July, although the actual level is remaining quite low compared to where we would expect it to be this time of the year. Looking in at the actual prices that we've got here, obviously I've mentioned stainless steel and steel itself, but what I think is quite interesting to note on these prices is definitely the trend in battery metals that is shown here. And this graph implies quite a dramatic pullback in cobalt and lithium prices, but that's driven more by the fact that when this graph was started back in early 2018, there was a very big hype around these battery metals, looking into the future for the EV transition in global autos, as well as the need for sustainable energy generation and energy storage. So the demand outlook for battery metals is very strong and remains strong at this point. But that actual physical transition was quite a lot slower than people expected, and the imbalance between the demand expectations and the availability of supply, which was good enough to meet the demand, meant that the higher prices we saw at early 2018, given the strong long-term outlook, encouraged quite a few producers to expand their output or put new projects into play, which then pushed far too much supply into the markets and caused these prices to correct back to more natural levels. And now, obviously, this year with the pullback in actual auto manufacturing, that has kept this downwards trend in play. But as we move through this crisis and that transition towards EVs continues, those battery metals should pick up quite firmly as we head into the longer term. One other aspect I'd like to point out on this graph is that I've introduced platinum as an end cost for the auto sector, and that's because platinum and other PGMs are used in auto catalysts, which are used to reduce the emissions of vehicles. And the fact that these constraints and the environmental issues and the need to reduce emissions has been increasing in recent years is forcing these auto catalyst manufacturers to put more PGMs into their filtering systems to reduce the emissions and meet the correct standards as we go forward. So there's a good fundamental drive for platinum pushing those prices up, as opposed to most other prices in this market, which have been in fundamental decline for the past few years. Platinum has shown some support coming through, although obviously the current malaise in the market is pushing down on this price as we speak. But as they recover, they should outweigh whatever constraints we see coming through the other countries that are still remain constrained for this year. As we head into next year, we expect this recovery to continue based on the fact that we expect an effective vaccine to be developed and start to roll out through the year, helping to maintain a fairly firm recovery as we go through next year. But one thing to note is that the figures I'm showing in this graph are quarter on quarter. So while it shows a very strong improvement through the second half of this year and some good continued growth through next year, in terms of overall output, but we would only really see levels of what was seen in 2019, potentially by the end of 2021, only in 2022. And in certain cases, the output in a specific sector will remain constrained all the way through to maybe 2023, 2024, especially in those areas where this transition is forcing some structural shifts in how the demand is met, like in hospitality and tourism, that sort of thing. Those sectors are expected to remain quite constrained for several years as we go forward and try to realize how to work around this new normal of ours. But then looking a bit further into the more fundamental medium-term drivers, the fact that we're seeing lots of domestic and multinational infrastructure programs being supported, as well as now encouraged by further stimulus, the fact that the urbanization trend around the world is continuing and that there should be a return to a rise of middle-class incomes in developing nations, should also be a further tailwind to our growth potential. And then also the potential for technological innovation should leave us in a place where efficiency will improve and productivity is boosted as we go through the next 5 years, also helping to maintain a good moderate growth rate as we head through time. But there is a flip side to this coin, in that the stimulus efforts we're seeing play through in the world are very highly debt-driven, and the fact that we have quite a high debt burden at the moment globally, as more debt is pushed into the system, the risk rises of defaults turning up in certain areas and financial risks pitching up in certain economies. And it furthermore has an impact on potentially pushing inflation beyond what economies can tolerate. So that stimulus, while it's very good in the short term, definitely has some medium-term risks associated with it as well. And then another tailwind which we expect to filter through in the coming years is that a factor which was in vogue as such for the last couple of years, being the tensions between the US and various other major elements of the global economy in terms of trade, is expected to come back to the foreground quite strongly and force continued restructuring of supply chains as we go through. In fact, in recent times, we've actually seen that tension flare up again between China and now, in very recent times, between the US and Canada again, in terms of their product trade. So as that continues to factor in and they try to resolve those issues, we expect that the restructuring of supply chains around the world will introduce a slight issue of inefficiency and raised costs, which will detract from our growth potential slightly. But overall, we do still expect that there will be a fundamental moderate growth rate as we progress into the next 5 years or so. And that concludes my global overview. Thank you for joining us.